Hello, and welcome to the Invest with Carl podcast. This podcast will bring you obviously everything about Carl investments, discussions about new features and strategies being launched, as well as commentary on general alternative investments news, slanting towards quantitative perspectives and the general democratization of sophisticated investments. Or said simply, bringing high-quality, sophisticated investments to all investors. We're looking forward to the conversation, so let's get started. Hello, I'm Jamie Uppenberg, your host today and a member of the Carl team. Today, I'm briefly kicking off our Carl Risk series with an explanation on why we dedicate a whole series to the topic, risk. In my last solo episode, Demystifying Quant Hedge Funds, I mentioned institutions and the uber wealthy have been using hedge funds for, really years. And I talked about the regulation changes that happened a couple of years ago and how that's really allowed the hedge funds and Carl to be able to market the funds to regular accredited investors. It's quite a shift in the industry. But I didn't really talk about why the institutions and the super wealthy have used hedge funds. Why are they looking at hedge funds and quantitative hedge funds? And what do they use them for? And maybe you're not aware that the funds, even the funds within the Carl universe, the quant hedge funds that Carl offers, they have been already anchored and funded by institutions and some very wealthy investors. And we're talking, there's 10 million and then there's 30 million plus that people and institutions have invested in these funds. So it's a lot of money. And why do they put it there? What are they looking for within these funds? It's important to know because these are sophisticated investors. They are professional investors who manage large amounts of cash, multi-millions, and they generally work for the people who have the cash. So you're talking about pension funds, corporations, government workers, labor unions, maybe sovereign wealth funds for entire countries. And then there's cash assets of insurance companies, corporations, and trust funds. These are people who are hired. They are professional, sophisticated investors, and they understand the tools involved in the hedge funds, the leverage tools involved, and they also understand the risk levels and the recovery periods. And these are all pieces of data that you'll want to look at when you're reviewing Carl funds as well. But they really understand that for taking certain sets of risk, then if the fund, doesn't have a great day or week, there are recovery periods for that. And they build all of that into their considerations and their portfolios. And when they build that into their portfolios and they look at hedge funds, they look at the diversification options. And they're looking at this, the management of the risk, usually more than they're looking at how much gains does the fund have and how quickly. That certainly comes into play. The fund should be growing and gaining, but really it's about reducing overall volatility. So as a fund gains, they actually want to limit the drawdowns on the fund, and they want shorter recovery periods if the fund does draw down. That's all risk management. And that helps a fund overall. So as a professional investor working for an institution, if they look at hedge funds, they're looking to have the fund be uncorrelated with the rest of their portfolio, because that provides true diversification. If a piece of something they've invested in is down, they don't want it to really be impacting the total portfolio, and they don't want it down for very long. And let's think about that. That makes sense, right? Because as they are hired to manage a core multi-million dollars, really their goal is to grow that money and to not impede on the original assets. that would be bad, right? They should not be losing money to the point of the original assets losing money. So yes, they need to grow, but they need to shave off the volatility of the growth, right? They need the drawdowns to be more shallow, and they need the recovery periods to be faster. That's all looking at risk. So uncorrelated with the rest of their portfolio and better risk adjusted returns. And these institutional investors are more interested in those items than they are with like super high, crazy returns. Even though I know that the super high, crazy returns and a lot of risk is the stereotype of hedge funds. Like that would be what hedge funds would be used to talk about, someone taking a crazy investment risk in the movies, for instance. While in reality, the overwhelming majority of the time, that's not what's happening. You're talking about people who have high investment skills and really looking at reducing the volatility. Now, these investors know that a diversified portfolio will increase total returns over time by reducing that volatility. And those of you who are playing along in the podcast, you know this. We talked about this briefly with Ernie Chang from Olympus, right? He talked about Olympus and the fact that during when the market goes down, Olympus goes high. It's that type of fund, and that will lift a total portfolio because of keeping your money invested and moving rather than having to manage the drawdown has more money growing, right? That's going to lift the overall portfolio. Compounding, essentially it's compounding, right? That's the core of investing, while also the whole point is if you can limit the drawdowns and keep the compounding up, keep more money in your fund, you do that over time, you lift the total portfolio. So professional investors are seeking greater control, less volatility, because it lifts the total portfolios and less possibility they eat into any core funds they're managing, which really they cannot do, right? Cannot do. This is what Carl offers investors. We're looking to make sure you have as many of these types of controls available within the hedge fund world, meaning we pull funds from different types of markets, right? So that we can stay uncorrelated to common markets. We have different trade durations that we're looking at, sources of alpha, if you know what that means, and the instruments that are traded as different markets. We're looking to make sure that whatever you need in your portfolio, there is a diverse enough options strategies within the Carl universe that you can find just the right portfolio solutions for you. Essentially, these are not your grandma's mutual funds, and you'll see us talk more about that, and we may put some of this up on our website in the coming weeks. But these are meant to be more than the traditional portfolios, and that's how institutions use them as well. So they have these risk controls, and how you look at risk within a fund, you can find the data on the risks of the fund within the analyze section of the Carl app. So on the app in the lower menu, it's the little magnifying glass that's analyze. And as you look at a fund, you can find their annual volatility, their recovery periods, all of that is in there. And these are important if you're using them to balance and diversify your portfolio. In addition, you'll see some funds, they have specific utilities, specific objectives. So they'll also have specific volatilities that they're targeting. And that could be part of the risk controls. It could mean they're more risky. They also might be like Olympus, where they're hedging a down market and different utilities like that. So you can find that as you analyze each strategy type. Now, overall, with Carl funds, you will find that they are data-driven and they use a scientific approach to investing. That's because they're all quantitative hedge funds. So there's not so much people making decisions involved in our funds. That's very important to us to make sure that you're not dependent on individuals, but that the strategy overall is, soundly within technology, and you can count on it over time. And you may have heard Alex talk about last week that you can count on it over time because we know we have the due diligence involved to know that the fund is always looking at its strategy and making adjustments as necessary. That's the research and development that Alex was talking about. All right. So why are the institutions using them? Honestly, risk control is, it's almost more than the gain, because they know if the risk can be controlled, the gain will be higher over time. That is the story. And that is the story of hedge funds, even though their stereotype might make you think differently. With that, we will continue the story of risk and the conversation of risk with each of our fund managers. We do add about a fund a month, and we'll still have an initial conversation with any new funds that come in. So I'm really looking forward to talking about more how each fund manages their risk and how they're doing that for us. If they can manage risk, they know the fund will outperform markets. And so how they do it is important to your decisions. All right. We have here at Carl, we are working hard on our new Carl IRA. In a month or two, probably more like 2, we should be offering a Carl IRA, and you can bring over retirement funds without the tax impact. So that should be exciting as we continue the risk conversations and add on some more funds as the months grow on. Really great talking with you all today. I'm excited for this series and look forward to the guests. Thank you so much. Talk soon. Bye-bye now.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app,